If you're earning 40,000 to 2 lakh rupees a month and you think investing is just for rich people, then this video is for you.
So today we'll be covering what I'd fix first before I start investing, common asset types simply explained with a brief history, and lastly, exactly how I'd be investing 5,000, 30,000 and 1 lakh rupees per month. 1 रुपया भी इन्वेस्ट करने से पहले here's what I want you to fix first. High interest loans. I'm talking about credit cards, personal loans, car EMIs, anything that charges you more than 10%. You know why? Because your investments might give you more than 10% a year. Some अच्छे साल में 15%, बहुत ज़्यादा अच्छे साल में maybe 20%, but they are risky, right? कोई guarantee नहीं है, but your loans, they're guaranteed to charge you that. Simple rule. Clear any loan charging more than 10% a year before you invest. It's not flashy, but it's the most reliable return on investment you'll ever get. Next, make sure you're protected. That means two things: health insurance and term life insurance. Let's start with health insurance. Even one hospital bill आपकी पूरी savings उड़ा सकता है. Ideally, get a policy of at least 2 to 3 lakhs. More if you can. If your company gives you one, great. But still get a personal policy because your job can change and then your coverage will end. Now for life insurance. This is only for you if someone is dependent on your income. It could be parents, it could be future kids, it could be spouse, it could be present kids. Whoever depends on your income, make sure they don't suffer financially after you die. You'll always be at peace of mind. How much? Simple rule, 25 times your annual dependency. So if someone is dependent on 30,000 of your income, then ideally get around like 60 to 90 lakh rupees of insurance. For term life insurance, you need to look at the claim settlement rate. And please stick to pure term plans. You're buying peace of mind. You're not buying an investment scheme. Last thing you need to do before you start investing, build an emergency fund. What is an emergency fund? It's a separate pool of money you keep aside for unexpected life expenses. Things like your pet needing surgery, your phone getting lost, or you might face a job loss. Things that aren't typically covered by insurance. Now, why do you need an emergency fund? So that when these unexpected life expenses come your way, then you have the bandwidth to tackle them and you don't need to actually take out money from the market. I'll give you an example. A few years back, my dad needed surgery. Insurance covered some of it, but I still had to pay about 85,000 from my own pocket. Now, if I didn't have that emergency fund, I would have had to dip into my savings, stop my SIPs. Because of that, I would have lost momentum. I would have lost the opportunity to really compound on that and really build serious wealth. I would have lost probably lakhs over a couple of years. Instead, my emergency fund took the hit and my investments kept compounding. So, how much should you keep in your emergency fund? A good rule of thumb I recommend is about 6 to 9 times your monthly expenses. So if your expenses are 30,000 a month, I would recommend keeping about like 1.8 to 2.7 lakh rupees. I personally park my emergency fund in a liquid mutual fund called Mirai Asset Liquid Fund Direct Growth. Don't look for a high ROI here. It's meant to be safe and it's meant to be liquid, just there when you need it. Let me first tell you about the different types of assets so that when you actually make that decision, you're making it from an informed standpoint. Let's first talk about stocks. So stocks exist because big businesses need money. It all started in the early 1600s when the Dutch East India Company wanted to finance expeditions to the east and to the west. Unfortunately, because of the risky nature of their work, big rich people or banks were not willing to fund them because there was risk of high seas, open water, pirates, etc. So they did something revolutionary. In 1602, they raised money from the public, selling shares of the company in return for a share of the profits. And just like that, the modern stock market was born. Today, that model continues. Companies raise money by offering ownership in the form of stock. If they win, you win. If they fail, you fail. That's why stocks are inherently risky, because stocks offer high potential, but they also carry great risk. Fast forward to 1774, about 170 years later. A Dutch merchant named Abraham van Ketwich noticed small investors wanted to grow their money, but putting all their money in one single place was very risky. So he launched the world's first mutual fund called Indrat Macht Mag, or Unity Creates Strength. The idea was very simple. Everyday investors pooled all their money into one single place, and that single place diversifies it across multiple different companies. So no single failure could wipe out the whole fund. That same idea powers mutual funds today. You invest, and a professional fund manager allocates the money into different assets, stocks, debts, or any other asset. Mutual funds make diversification and professional management available to everyday investors. Before we talk about index funds, you need to understand what an index actually is. An index is simply a list of the top companies of an economy in a market grouped together to represent a part of the economy or the stock market. For example, the Nifty 50 is an index of the top companies in the National Stock Exchange. S&P 500 is a list of the top 500 companies in the United States of America. When people say the market is up 2% today, they're usually talking about the index because it acts like a scorecard of the economy or the country. By the 1970s, people realized that many mutual fund managers were consistently underperforming the market index. They were charging high fees, bold bets, but still underperforming. So, in 1976, John Bogle launched the first index fund. Instead of trying to beat the market, it simply mirrored it, buying all the top companies in an index like the S&P 500 or the Nifty 50. Just steady long-term returns. Today, index funds are one of the best ways for beginners to get exposure to the equity markets without trying to guess which stock will win. Now, we've covered stocks, mutual funds, and index funds. With the exception of debt-based mutual funds, which we'll cover shortly, these form the basis of non-fixed return-based investing. You earn when the market earns, you lose when the market loses. Next, let's talk about debt. Before stocks, before mutual funds, there was lending. People have been giving loans and earning interest for thousands of years. Governments, kings, companies, they all borrow money. And you can lend to them to earn interest. Debt-based mutual funds invest money in bonds and fixed income instruments. Basically, you lend money to entities and they promise to pay it back with interest. These are lower risk, lower return compared to equity. Great for when you need short-term stability. Lastly, let's talk about gold. Gold has been trusted for thousands of years, not because it grows fast, but because it holds its value. Long before we had rupees or dollars, people used gold as currency. It was rare, portable, and globally accepted. Even today, when economies shake, like in times of wars or crashes, gold often holds its ground. It's not for fast growth, but for protection. Modern investors use gold ETFs, sovereign gold bonds, or gold-based mutual funds to hold a small portion, maybe like 5 to 10% of their portfolio as a hedge. In a small nutshell, these are the different asset types. Now, the exciting part, investing. First, there are a few rules I personally follow. Here are these. Don't pause your SIPs, even if the markets go down or your portfolio goes down. Look at your portfolio once a month, not more than that. Third, rebalance your portfolios only if your income increases or decreases. Lastly, keep topping up your emergency funds every month. Now finally, let's look at the breakup of how I'd invest 5,000, 30,000 and 1 lakh rupees per month. Basic assumption, more than 10% interest debts are paid off, health and life insurance is in place, and emergency fund is also in place. If I were you starting today with 5,000 rupees to invest per month, here's exactly how I would do it. At this stage, your focus shouldn't be on chasing the highest returns or trying to beat the market. You don't need to experiment. You need to build consistency and discipline. Your biggest asset right now isn't money, it's time. Focus on growing your income and skills. And meanwhile, build something that just compounds quietly in the background. Here's the simple allocation I'd start with. Nifty 50 index fund, I'd allocate 3,000 rupees a month. Gold mutual funds, I'd allocate 1,000, and I'd keep topping up my emergency fund by about 1,000 rupees. Personally, I use Coin by Zerodha to invest in Navi Nifty 50 index fund. This is my index fund allocation. Quantum Gold Savings Fund. This is my gold fund allocation. And Mirai Asset Liquid Fund. This is my emergency fund allocation. I'm not earning any affiliate income on these. I am not sponsored by them in any way. This is just my take. This is what I do. Make sure you set up SIPs. SIPs are systematic investment plans. And I recommend these because you can automate your habit. Instead of thinking every month and second guessing yourself, it's just out of your mind. Let it compound every year. Remember, your 5K per month isn't supposed to be exciting. It's supposed to be effective. By the way, 5,000 a month might feel small today, but remember, in 1 year's time, that's like 60,000 of your money already invested. In 5 years, that's 3 lakhs. And with growth built in, that will probably be like 4 to 5 lakh rupees in 5 years. If I were you starting with 30,000 rupees a month to invest, here's exactly how I'd structure it. I'd put about 10,000 in an index fund like the Nifty 50. It's great to form the core of your portfolio, low cost, broad equity exposure, great for long-term wealth creation. I would also invest about 10,000 in actively managed flexi or small cap funds. These add good alpha. Actively managed funds that have shown consistent returns across 3 to 5 years, I'd invest in 2 of them, 5,000 each. Next, I'd invest in gold funds or sovereign gold bonds via SIPs to the amount of about 5,000 rupees a month. It's great to hedge against inflation and market volatility, and it keeps your portfolio balanced. Next, I top up my liquid fund or emergency fund by another 5,000. Here, I'm just looking to park my money, and maybe in the future, this might also act as an opportunity fund. I personally think of an opportunity fund as something that I can use to invest in the market when the market dips, so as to gain back when it rebounds. Now, what mutual funds to invest in? I personally invest in 2 mutual funds, Quant Small Cap Fund Direct Growth and Parag Parikh Flexi Cap Fund Direct Plan. Both have shown strong long-term performance and consistent returns across 1, 3 and 5 years. Always look for this before investing. Market consistency is extremely important. Lastly, let's talk about the investment structure I would follow if I was starting with investing 1 lakh rupees per month in 2025. At this point, I would start building for freedom. Here's the allocation plan for how I'd structure it. Again, I would be investing 25,000 in index funds, core passive exposure to the Indian economy, low cost, low maintenance. Next, I'd invest 40,000 in actively managed funds, flexi or small cap. Again, more exposure to growth, and I would split them across 3 to 4 solid performers for diversity. At this point, I would also start investing in international funds, 10,000 to start with. It gives me global exposure and geographic diversification. I'd also invest 10,000 in gold funds or sovereign gold bonds, gives me hedge against inflation and stock market volatility. And lastly, I'd also top up 15,000 into my emergency fund. Next, let's talk a little about real estate. At this stage, most people start asking, should I invest in real estate? My take on this, not unless it's in a high liquidity metro city area and you're perhaps planning to live there or you are going to rent it out. Please do not invest in real estate for speculative price appreciation at this point. You need to be earning a lot more. This is because real estate has high transaction costs and low liquidity. It can keep you locked in for years before you start seeing any returns. Remember, automate your SIPs, revisit your goals once a year, and go build your life. And don't focus on the market noise. Start small, stay consistent. Whether it be 5,000 a month or 1 lakh a month, the real flex is discipline. If you're serious about building wealth step by step, hit that subscribe button. We're just getting started.